This is Jim Lee of Strategic Foresight Investments, and I'm here to walk you through our market update for the first half of 2018. Over the next few minutes, we'll talk about the recent market correction and provide a forecast of what we're expecting over the course of the next few months. This is a chart of the S&P 500 index, and you can see here that the market was getting just a bit overheated in January, breaking through the high end of its trading range, then going from extreme overbought to oversold conditions within a short 2-week period. The market pulled back into correction mode, declining about 10 percentage points before finding support at the 200-day moving average. This is really just classic textbook technical analysis here. Now, in the past, it's been a good idea to pick up a few shares every time the relative strength indicator drops to 30 or below. This is really your signal to buy the dip, so to speak. Long-term trend is still very much in place, and it's my sense that we'll finish the year positive with returns in the low to mid-teens. Now, clients are asking me, how long this is going to last, and my sense is that we still have a year or two before the next significant downturn. Now, if we combine the most influential trading cycles of the last 50 years, it really looks like the secular bull market that started back in 2009 could stay intact until the second half of 2019. Now, 2020 and 2021 still look a bit dodgy, and there's a very good chance that we'll be getting more defensive a little bit before that time. The big news for now is that inflation is starting to pick up, and after a 25-year decline, interest rates are on the verge of breaking out with higher inflation. U.S. 10-year Treasury bonds now yielding right around 2.9%, up from a low of 1.5% in 2016. And contrary to what you might hear, rising interest rates are not always bad for stocks. There have been only 6 periods of rising interest rates in the past 3 decades, and the S&P 500 and the Dow Jones Industrial Average rose during 5 of those periods with average gains of 23%. But there's still going to be winners and losers to that. This is a market map with data on 500 different companies in one snapshot. Green is good, red is bad. You can see that some of the more interest rate sensitive sectors of the market are lagging. These would include utilities here in the lower right-hand corner, also REITs, otherwise known as real estate investment trusts. Meanwhile, technology and financial stocks still looking very good, and I would expect basic materials and energy stocks to turn the corner and start doing better fairly shortly. So in summary, be careful of interest rate sensitive assets. These could include utilities, REITs, and long-term bonds. This could be a tough time for more income-oriented investors. We're also heading into the later stages of a long-term secular bull market cycle. And this means a more inflationary environment with higher interest rates. Historically, this has been good for basic materials, energy, financials, and technology stocks. Emerging markets had a fabulous year and are still looking good for the next 12 months or so. So thanks again for your time and interest. If you have any questions, feel free to call or send an email to me here at jlee@stratfi.com.